Imagine waking up one morning, checking the silver price, and realizing it's crashing faster than anything in history. Not 2008, not 1980, something far bigger, something no one saw coming. And if you think 1980 was wild, 2026 is about to make it look like child's play. Silver has always been a safe haven, a financial escape hatch in times of chaos. But what if the very thing we trusted is hiding a storm so massive it could shake the world's markets to their core? Today, we uncover the hidden signals, the warnings buried beneath the headlines, and why 2026 could be a year you'll never forget. Right now, most investors are blind to the signs. Silver isn't just moving, it's trembling, cracking under pressures that aren't being reported. Central banks are quietly adjusting policies, while big institutions are stacking positions in shadows. The charts you see on mainstream sites don't tell the full story. There are distortions, manipulations, and unseen forces pushing silver toward a threshold that hasn't been tested in decades. History tells us one thing, silver crashes don't just happen, they explode. And when they do, the speed is terrifying. 1980 was extreme, yes, but the next collapse could be unlike anything you've imagined. Markets are whispering warnings. Every unusual trade, every subtle move in futures, every silent shift in demand is a breadcrumb. And if you follow them closely, you might just see the storm before it hits. Picture this. It's a normal Tuesday morning in 2026. Coffee in hand, you check your portfolio, and silver is in freefall. Headlines scream about chaos, yet nobody knows the real reason. Governments scramble, hedge funds implode, ordinary investors panic. Your neighbor, the one who always brags about being market smart, is calling brokers in desperation. Shops, industries, even entire regions dependent on silver production feel the squeeze. In a matter of hours, the calm confidence of the past decade is shattered. People are forced to sell, forced to make choices that could destroy their savings. And all of it could have been predicted. If only the warnings had been seen, the hidden signals noticed. Here's what most people don't know. Silver inventories are thinner than reported. The metals held in vaults may not even exist in the quantities we're told. A few major institutions control enormous portions of physical silver, and their moves alone can trigger panic. Futures markets are rigged in subtle ways, creating illusions of stability while a collapse quietly builds. Historically, every hidden buildup of pressure has led to an explosion, and silver has been quietly reaching that tipping point for years. Combine all this, and the stage is set. The public sees calm, the news reports optimism, but underneath, the storm is forming. The 2026 silver collapse is not something that will appear overnight or without warning. It is a slow, almost invisible buildup of pressures that the mainstream media and casual investors are completely unaware of. Silver has always had a dual nature. On one hand, it is a trusted safe haven, a tangible asset that people turn to in times of uncertainty. On the other hand, it is vulnerable to manipulations and market forces that can accelerate crashes beyond expectation. To understand why the upcoming event could make 1980 look minor, it's important to look at the layers of hidden dynamics that have been quietly forming beneath the surface. The first layer involves supply and demand fundamentals that are rarely discussed outside specialized financial circles. Physical silver inventories are thinner than most people realize. The reports released by government agencies and industry groups often paint a picture of abundance, or at least stability. But when you dig deeper into warehouse holdings and private vaults, the numbers tell a different story. Large portions of silver are held in ways that are not fully transparent, and a significant amount exists only on paper through contracts and futures positions, not in actual physical form. This creates a precarious situation where a relatively small shift in buying or selling activity could trigger an outsized reaction in price. The second layer involves institutional control and the concentration of ownership. A handful of major players, from hedge funds to multinational corporations, dominate both the physical and paper silver markets. Their decisions, trades, and even the smallest adjustments in position can have ripple effects that ordinary investors would never anticipate. When you combine thin inventories with concentrated control, the stage is set for sudden, dramatic price swings that can appear almost engineered. What most people fail to realize is that markets are not purely driven by fundamentals. They are also heavily influenced by perception, psychology, and the subtle mechanics of derivatives and futures contracts. Futures markets, in particular, allow institutions to create the illusion of stability while quietly preparing for large moves. Contracts can be rolled, positions can be shifted, and manipulations can occur without leaving obvious traces to casual observers. This creates a situation where prices can seem calm and stable, while underlying forces are quietly building immense pressure, ready to release at any moment. Historical patterns show that silver has a tendency to behave in extremes when these hidden pressures reach a tipping point. In 1980, the price of silver skyrocketed due to a combination of market speculation, geopolitical uncertainty, and sudden demand spikes. While it was dramatic at the time, the current environment contains elements that are far more complex and intertwined, meaning the potential for a sharper and faster collapse is very real. Another critical element involves the role of central banks and government policies. While gold often receives attention as a central bank asset, silver is impacted indirectly through interest rate decisions, monetary policy, and industrial demand projections. Central banks may be quietly adjusting strategies that influence the broader commodity markets, including silver, in ways that are not immediately visible to the public. These adjustments can amplify existing tensions in the market and accelerate price movements when combined with other pressures. Industrial demand adds another layer of complexity. Silver is not just a financial instrument. It has critical industrial applications in electronics, medical technology, and renewable energy. A sudden shift in industrial demand, whether due to technological change, supply chain disruptions, or policy shifts, can create volatility that compounds the effects of market manipulations and thin inventories. On top of these structural factors, there is the psychological component. Investors tend to react more violently to uncertainty than to clear trends. When a hidden imbalance begins to surface, fear spreads faster than information, leading to panic buying or selling that can exacerbate price swings. In many ways, the human element is the accelerant that transforms a contained problem into a full-blown crisis. The convergence of these forces, thin inventories, concentrated ownership, futures market mechanics, central bank policies, industrial demand, and psychological reactions, creates a perfect storm that is poised to unfold in 2026. Unlike in 1980, where information traveled slowly and responses were delayed, today's markets operate at lightning speed. News spreads instantaneously, trading algorithms react in milliseconds, and retail investors have access to tools that can amplify market moves. This means that any hidden imbalances could be exposed and magnified far more rapidly than in previous decades, leading to a collapse that is sharper, more chaotic, and potentially more damaging to portfolios and economies. The warning signs are subtle, but present for those who know where to look. Unusual patterns in futures rollovers, sudden accumulation or disappearance of physical silver in key vaults, and discrepancies between reported and actual holdings are all indicators that the market is under stress. Analysts who pay attention to these signals may see the storm forming, but even they often underestimate the speed and intensity with which these pressures can materialize. When the tipping point is reached, the result will be a cascade effect. As prices start to move sharply, institutions may be forced to liquidate positions to protect themselves, triggering further price declines. Retail investors, seeing rapid losses, may panic and sell, creating an acceleration of the crash. The feedback loop is self-reinforcing, and once it begins, it is difficult to stop. What makes this scenario even more alarming is the interconnectedness of modern financial markets. Silver does not exist in isolation. It is linked to other commodities, currencies, and derivative instruments. A significant move in silver can spill over into gold, copper, and even stock markets, amplifying the overall impact. Banks, hedge funds, and investment vehicles with exposure to multiple assets may experience stress simultaneously, further magnifying the effects of the collapse. Another aspect that often goes unnoticed is the timing and alignment of global events. Geopolitical tensions, monetary policy shifts, and unexpected disruptions in supply chains can all converge to act as catalysts. While any single event might be manageable on its own, the combination of several small triggers can produce a disproportionately large outcome, tipping the market from stability into chaos. In this sense, 2026 is uniquely positioned to experience a silver collapse of unprecedented scale. The market has never been more leveraged, more interconnected, or more vulnerable to sudden sentiment shifts. Retail investors, institutional players, and even governments may find themselves reacting to events rather than controlling them, caught in a whirlwind of rapidly escalating consequences. Awareness of these dynamics is critical. Understanding the mechanisms at play, recognizing the subtle signals, and preparing for the possibility of rapid market movements can mean the difference between survival and devastation. The collapse will not just be a numerical drop in price, it will be a stress test for portfolios, financial systems, and individual preparedness. Those who dismiss the warning signs, who rely on the illusion of stability, or assume that history will repeat itself in a predictable pattern, are the most at risk. The unprecedented convergence of hidden pressures, manipulations, and systemic vulnerabilities makes this potential collapse unlike anything experienced before. If you think 1980 was the benchmark for chaos, think again. The next silver collapse won't just be a number on a chart. It could redefine wealth, risk, and survival. The signs are here. The hidden movements, the unusual trades, the whispers in the market, they are all pointing in one direction. And when the tipping point hits, it will be fast, brutal, and unavoidable for those unprepared. Pay attention, learn the signals, watch closely, because 2026 could be the year silver teaches the world a lesson no one saw coming.